Distribution. So we are going to have the same phases, and the intention behind the phases is the same. Phase A, stopping action. What are we stopping? The previous uptrend. How do we recognize that stopping action? By several points. One of them is going to be climactic action, and here again there are quite a few nuances on the climactic action after the uptrend. One of them is that in stocks, especially in the mature stocks, you might not recognize the climactic action at the time when it happens. And the reason why is because mature stocks are not going to necessarily produce you a big spread to the upside, acceleration of the price to the upside. They might have some gap in action, but it's going to be a little bit difficult to identify a climactic action. Sometimes it's extremely evident and sometimes it's just hidden. So another way to identify climactic action is actually after the fact on the change of character of the automatic reaction. So change of character happens and we are assuming that we're going to go into the non-trending environment after the trending environment, and therefore, as we assume that non-trending environment has started, we're doing our phase analysis. In phase B, during the distribution, we would be looking for the signs of weaknesses, minor sign of weaknesses in phase B, upthrust actions that are where the price commits to the upside temporarily and then goes down almost instantly back into the trading range. The last upthrust action as a higher low is going to be in phase C, and again, phase C intention is all about testing of the previous highs, and testing how demand is capable of moving the price to the upside, and testing the availability of the supply at the resistance points. And then going into phase D, we are producing our change of character where the price travels, commits below the support, and usually this is going to be the largest reaction to the downside. It might have a much better supply signature. It might have increase of the spread to the downside and so on and so forth. And then a last point of supply rally that's going to fail is going to be the smallest rally in the whole trading range. And usually the narrative here behind these actions is that during phase C and D, composite operated big institutions already do not care, they do not care about hiding their footsteps. They are aggressively selling because they see something on the horizon that is not good for that particular stock or the instrument, and therefore their distribution is going to be more visible. And it's going to be more visible, from the commitment of the price below the support, or, from the spread that, we're going to see on the sign of weakness reaction. All right. And the last concept for us to discuss, and I think we're good with really doing well with the time here, is the definition of this vein. So this is somewhere where I want to stop a little bit and see if we have any questions, because for those of you who have taken advanced Wyckoff course completely, and especially the 4th months, you are familiar with this concept. For those of you who have not taken the 4th months of the advanced Wyckoff course, or you haven't taken advanced Wyckoff course at all, this is going to be new, because this is not in the methodology. This is something proprietary that I've developed for myself, for my own trading. But it's really crucial for us to understand the swing analysis you know, how do we identify the swings? Usually people would say, okay, well, I would take the high and I would take the low, and that would be my swing. But it's not as easy as this, you know. So for instance, how do I know that, let's say at this point right here, that the swing has not reversed? So the key concept here is a swing reversal. At which point, at which particular bar do we actually know that the current swing is done and that we are potentially in another swing? So let's look at how we would handle this. I'm identifying what I call a significant bar. Significant bar usually are going to have big spread. It's going to have the close that is going to show the commitment to a trend. So therefore, if we have a significant bar to the downside, we want to see the close below 1/2 of the spread. So big spread and good close. And then we also want to see that commitment, the close, which is going to be above, so let's say this bar right here. This close is going to be above the previous commitment line that was created by the short-term resistance. So in this case, the previous bar has this tail to the upside. This was the highest level where the price could travel at that point. So we want to move the price to the upside in the manner that's going to commit above this line right here and close and hold there. So therefore, every time you have a significant bar, this is what you would like to do. So let's just go through this, and it's going to be more self-explanatory. I see that the last significant bar right here is to the upside, so I'm assuming that there was an upswing at this point. So my commitment for the reversal to the downside is all going to be about this level right here, this low. So I'm looking for a bar that's going to commit below this level. And here is this bar, and it is a significant bar, which is really great. The true range of this bar actually has started at the previous close right here. And we see that the body of this bar is big, the close is below the 1/2 spread, and we see that the reversal has happened, and now we can say that we are in the downswing. As the price goes down, it creates new commitment levels, and my commitment level to the upside, if I want to reverse, is all going to be about this bar right here. This was the last significant bar to the downside. So therefore, this is the bar that needs to be reversed. So I'm placing the commitment bar, the reversal bar for the upside at the high of the true range of this bar, and I'm just basically waiting for the price to reverse this level. There is an attempt to reverse it, a big bar to the upside, but it's not coming to this level. So therefore, there was no reversal, at least on this time frame. The next bar commits to the downside. It's a big significant bar. So every time we have the new commitment, now let's say in this case to the downside, we're going to move the stop loss. So if this was our commitment to the upside and the stop loss level, this is the next level where we're going to move our commitment. Next bar, so let's say it's this one, and therefore our stop loss is going to be moved. Next commitment, and I apologize, I don't know why this moved a little bit, so it's covering some of the bars. So we're going to move the stop loss here. Next one, going to move the stop loss here. Next one, going to move the stop loss here. And then suddenly this bar reverses the last bar to the downside. So at this point, we are saying that the downswing is done. It has been reversed, and there was a reversal to the upside. And then we're just basically doing the same thing to the upside. We are looking for the significant bars, moving the stop loss. So the original stop loss was here, 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 here. Well, this one we really shouldn't. Here, and then with the big bars, what you can do is just to put it slightly below 1/2. Here, here, and here is our reversal. So look at this chart. I mean, this is price line on the weekly. This is the chart that I'm using in the advanced Wyckoff course. And if you would recognize on the weekly this reversal right here, and you would stay through the whole swing, you would travel in the straight from about $75 to about the close here on this bar was maybe about 210 or somewhat. So you are making a really good return here just on this concept alone. Now the question, does it work in all time frame? And that's the beauty of it, that it does. Now it's a trend following technique. So one of the disadvantages of that, and this is what I hear from students, is that it's not going to get you out at the top and it's not going to get you in at the bottom. But if you have a significant trend, you can catch a really good percentage of that trend. So you're going to catch probably from 60 to 80% of the trend. And that's what we want to do when we are trend following, when we are trending. We want to catch the majority of the trend, and our goal is not to actually, pick the top and the bottom. And this concept is going to be also very crucial, because when we go into the trading range and we see, let's say, a change of character bar, this bar most likely is going to be a reversal bar, and this reversal is going to be based on this concept. So we want to recognize the reversal of the swing as early as possible. Then think about what happens next. Automatic rally. And if we are day traders, and this is a daily chart, and we are recognizing that there is some kind of structure right here, and then on the daily there is some kind of reversal, our positions are going to be initiated here with an idea that the price is going to go lower to the next structural point, which is a secondary test. So therefore, swing reversal is extremely important, especially if you have multiple sessions on the way down. You need to define the swing bias and basically open all of the positions in the direction of that swing bias and in the direction of the structural context. And I want to kind of stop here because this is a really important point. So let's see if we have any questions. And let me just repeat this. Why do we need to understand the swing structure? For the intraday trader, you need to understand the daily swing structure because it's going to give you a directional bias. You need to understand the structural analysis of where you are in the higher time frame structure, because that's going to give you an indication of the next potential action within the trading range or within a trend. And therefore, it's also going to give you a directional bias. And yeah, so those are very, very important concepts right here. And one of the things, I think was the beginners in day trading is that there is no definitions like that. So therefore, at the beginning when we start day trading, we usually open up, like 5 minutes, maybe like 30 minutes, depending on the market. And we are trying to recognize, some patterns right there. But we don't really think about the magnitude or the strength of the patterns on the higher time frame. And therefore, sometimes what seems to be a very strong intraday pattern in one direction could be negated really quickly by a much larger trend on a higher time frame. So for those of you who are listening to me right now and you guys are thinking, well, I know this, you know, I kind of know this. But if you don't do this, if you don't look at that, then knowing is not really benefiting you, you know, in terms of, you know, consistency of profits. And usually it's those type of basic, you know, concepts that are going to bring you a lot of profits. You know, if you think that you know but you don't do, then you're going to fail more times than, you know, the person who actually thinks very consciously about those things. Okay, so and we'll talk a lot about this today. I kind of want to put this in your minds, you know, and to be extremely extremely articulate about this couple of concepts here. Okay, so what are the boxes here on this chart? Okay, so we have this box is the significant bar box to the upside. Reversal bars in blue, so I'm identifying specific reversal bars that are defining the swings. And then the green boxes here are significant bars to the downside. So yellow significant bars to the upside, green to the downside, blue reversal. All right. Yeah, and guys, it's great that you're asking questions, and I understand that the majority of you kind of already know this material, so that's fine. All right. Any questions on the reviews that we went through? All of the structural concepts that we need to go before we go forward. Any other questions, especially from those of you who have not attended Advanced Wyckoff course before? No questions. Okay, great. All right, let's see. So we have around 15 minutes before the next break. Okay, so let's go through the first case study, and you know, we'll see whether this is going to be, you know, whether we'll have to come back to this or whether we'll be done like in the next 15-20 minutes. So this is our first case study, and during the case study, I'm gonna throw an idea to you. So like right here, I put that this is idea number one. Idea number one, day trade when the long-term structure, daily swing structure, and intraday structure are all in sync. Sounds like a very easy idea, you know, to think of and to implement, but unfortunately, I think because of this easiness, there is such a disregard to this idea. So, and it's a very basic idea, but I want us to explore this in this case study and kind of like give it a lot of credit. So the instrument that we're going to look at is going to be Euro, US dollar, and the time frames that we're going to go through during this case study is going to be, we're going to start with the very long-term structure, monthly structure, and then we're going to come down to the daily structure, and we're going to look at the swings there, and then we're going to go to 240 as a structure for our points of entry. And actually, I think that I went one time frame below 240. Yes, I think it was maybe like 30 minutes, and I didn't put it here. All right, so let's look first the monthly structure. So this is a very long-term chart. And obviously, as a day trader, you're not going to be looking at this chart like every day. But whenever you start trading an instrument, you really have to think about analysis first and then trading. How do you start your analysis? You start with the long-term time frame. So for instance, a monthly, you want to understand the whole history of the instrument and then understand the more current history of where we are structurally. So we look at the history of euro and we see that there has been a big uptrend, and we're looking into this area when we're seeing a change of character, and this change of character has big down bars, the largest reaction to the downside, the fastest reaction to the downside. Almost all of the profits on the last downswing were negated. So this type of quick move to the downside has a specific narrative from big institutions as to what they're doing in this area. And it shows a lot of urgency to sell this instrument by big institutions. We definitely see this as a change of character, and therefore we are expecting a consolidation from this point on. Now, imagine how huge this consolidation is, right? So 1.6, 1.2. So we definitely have a lot of pips to collect here in between these two boundaries. So therefore, it's a prime opportunity for us to day trade this structure with an understanding of what should happen next, right? So for instance, as we're experiencing this reaction, and let's say we didn't catch anything, what do we expect next after the automatic reaction? We just went through the review of this, phase analysis and structural analysis. We would expect a secondary test that's going to try to come to the climactic action resistance here in order to retest it. And we know that it also can fail, it can overshoot the resistance. So therefore, in this area right here, we would be concentrating on any of the trades that are going to be, to the upside. Once we see some kind of failure, and this is the trade that Tom likes, so once we see that failure, we could take advantage of this because we know that there's going to be, this retest. So our day trading bias is going to be to the downside, and obviously this is monthly, but we can talk about the swing trades here and so on and so forth. And so on and so forth. So during this trading range, we could use our knowledge of the structural analysis to identify a directional bias for swing trades and for intraday trades. And obviously, as we go to a lower time frame, like daily, we're going to be creating different directional biases there. But big biases are all going to be created just because of this structure. So if you go to the intraday, let's say that you're going to the intraday action somewhere here, it's going to be really futile if you're just looking at the intraday. You really have to understand a much larger contextual structure where we are in order for you to be more confident about the direction that you're trading or the direction of the signals that you're looking for. All right, so let's go through this structure. Last lower high before moving to the downside was phase C, and please look at how, again, this power of 3 tests is playing out here. First test, second test, third test. And usually in the large structures, we're going to see a lot of that, like tests in each phase, and the last test is going to be your phase C. Even if you're wrong about phase C being there and it's still phase B, you have to think in terms of the scenarios. If this is a lower high in phase B, then what should happen next? The price should retest the previous support, so at least we're going to go here. On a larger time frame like this is a huge move, right? So for the intraday trader, all this, pips that could be collected here, and this is about 2,000 pips here, it's a huge gain. So therefore, even if we could be wrong in identifying a specific phase, but we could be extremely right in terms of how we're trading that swing. So some words specifically about the structure. So this is a different structure than we've seen, on the previous schematics. I talked about the urgency here on the change of character. This is a TP formation. And in a TP formation, again, we're going to have the lower lows going into phase B, and that's because supply is being provided right away by big institutions, and we have a lot of signs of weaknesses here in phase B, and we see that sign of weakness here in phase B. And that's because institutions are selling right away. They're not waiting for the trading range to develop to sell. They want to get rid of the position right away. And then after that, we usually go into some kind of apex formation where we see the failures of the highs to reach the previous climactic high. If we look at the volume signature during the apex is going to start contracting for both supply and demand. And then on the way out, we're going to see that the volume signature locally increased. Here, we just seen this with the price action, the price committing to the downside. So we are expecting that the volume signature is going to pick up here, especially in this area right here. And that's our kind of like typical TP formation structure. Now let's look into this area. So let's imagine that we are trading here. Looking at the monthly, it would be difficult for us to understand, where exactly we should open the position. And then, of course, from the point of opening to the point of where we have the stop loss, we might have a very significant, unit of risk right there. So we need to go to a lower time frame. So let's go from monthly to daily, and let's look at this area right here. And another question before we go there. Isn't volume a criteria to identify phases? And for us, yes, absolutely. And in the advanced Wyckoff course, we would devote a whole series, a whole month to the supply and demand signature, and we would go into the details as to the phase volume signatures. So each phase would have a specific signature and how we would look at those signatures all together. So this is something that, we'll definitely study, studying in April, and then specifically in May, you'll have more information on this. But today we just don't have time for so much material because there is a lot of material right there on volume. Okay, so let's look at the structure at the lower time frame here, going from monthly to the daily. And we're seeing that this was a long-term phase C, a potential long-term phase C at that point. This is how we're thinking about it. We see that even though this reaction is large, relative to this move to the upside, this acts as a change of character. This reaction is more than this one, and we see that the spread is increasing. So we're expecting some kind of consolidation. Here, the consolidation is somewhat upsloping with all of these resistance points right here resting on the same resistance line. I put kind of tentatively here a little bit, this slope, which looks a little bit different, but I think that for those of you who attended the advanced Wyckoff course already, you kind of see where I'm going with this. I want to see this major sign of weakness committing decisively to the downside. Plus, the two support points are kind of like, providing a confirmation that this is a good line as well. And we see that the next attempts to go up all fail, and they act as the lost point of supply. And we're still a little bit lost here because for our, intraday trading, this is a little bit too much. for the points of entry. If we're swing traders, we can find a position entry somewhere here in this area, but we want to be more precise. We want to create more sizing. We want to be more accurate in our entries. So let's look into this area. But before we do, and we'll come back to this slide, I just want to show you how great of a trade this was, and actually a couple of students actually implemented this trade. So the price goes down, and it seems that there could be a change of character here relative, to this reaction right here, and there could have been some exits here based on the idea that we might be consolidating, which we did, but consolidation is so weak structurally with the lower lows and the lower highs. This would be another area where we would enter this position again. This would not act necessarily as a change of character relative to this or to this area right here, so we might actually even stay with this. Or if you exit just based on this downswing, also not a bad idea, and then your next entry is going to be somewhere here. But this bar acts as a change of character bar. Remember, we've talked about this, right? A change of character bar that's going to identify the beginning of the change of character rally. Okay, and that's my cue that we're close to the break. This bar right here, this is the spread of this bar. Look at this spread. This is the largest spread so far in this whole move from up here to down here. Look at it, it's just so huge. So that tells us not only that this last swing is done, but most likely this whole move is done, and now we're going to go into the consolidation. And if we would be waiting for some kind of, like, let's say, secondary test, which comes later on, we still stay in this position for quite some time, for almost additional months. We can exit maybe at the better price, and if we're lucky, we can exit maybe on the next day right here if we're recognizing this as a change of character. But change of character bars are really crucial, to have a more effective exit. All right, why don't we stop here? And this is what's going to happen next. I'm gonna close this session because we want the recording to stop, and then I have emailed you guys the webinar links for all 4 sessions. Let me know if you don't have those links, but you should. I have sent those to you twice or 3 times already, so in the emails you should have the second webinar link. So I'm going to log off right now. That's going to stop the recording. The recording is going to start converting. We're going to have a 10-minute break. So let's get back at 10:30 our time here, Pacific, and then we're just going to continue from this slide, and let's just have a small break. All right, guys, I'll see you like in 8 minutes or so. Thank you. Bye-bye.